Okay, so let's finish up now on taxes. And I'm going to give you two examples that I put together for this class for personal financial planning so that you can see how they operate using the tax forms. A lot of the things that I'm mentioning to you, uh, especially if the terms are not familiar with you, it might be like I'm speaking in an entirely different language. And to a certain degree, I am. But let's just take a look at, okay, you're an you're an employee now, and you want to do your taxes. And you want to file them on time, which, like I said, is usually April 15th. Depending on holidays and things like that, it might be a day or so later. So let's now take a look at the form that is used. Every individual files a Form 1040. Okay, corporations, they have their own form, trusts have a form, partnerships have a form. All these different types of structures have their own types of forms. And it just so happens that the form for individuals is called a 1040 form. So originally this form was longer, and then they changed and essentially in some regards simplified the tax laws back in 2018. So the tax form is shorter than what it was previously. Now, I'm going to show you essentially what it looks like to do a paper form. So if you are using a tax preparation software like TurboTax or TaxAct, you may not necessarily see what this form looks like until the very end. Typically with this tax preparation software, they'll ask you questions, and then they'll put the numbers where they belong. And then at the end, then you will see what the tax form looks like, the 1040 form. So I personally have used TurboTax for many years, and I expect to continue to use them. They've been helpful. There is a cost for that. Some IRS, for example, I believe they have a way of doing this electronically online. You can do your taxes that way instead of doing an actual paper form. What you find is if you do an electronic form, you can get your refund from the government faster. So that is a consideration. So you have to provide bank account information and things like that so that they will directly deposit the money right into your account. Okay, so let's take a look at what a 1040 form actually looks like. All right, so this is the first page of the 1040 form. So it just so happened that I'm using the name of one of the 76ers, Joel Embiid. Okay, so let's talk about what you see on this form. So every form for the IRS needs to have your Social Security number on it. So this way, if the paper form becomes separated with other copies of your form, because usually these forms are a couple pages long. Some of them are very long. Very complicated tax returns could be very long. For most people, though, there are a few pages, but you are required to put your Social Security number on each form in the event that they get separated. So here we have a number I made up for Joel Embiid, just 987654321. That's here on the form. So whatever your number is, you would put that here. If you are married filing jointly, then you're going to put both numbers here along with your spouse's name. So then you're going to put your address, and I just happen to have Joel having the Rosemont address. So maybe he's a student here and we don't even realize it. All right, so so you have your name, your social security number, your address. If you wish to take some of the money that you are paying in taxes and have that money go to the presidential election campaign, you can check off this box right here. Notice though, Joel did not do that, but that's his decision, whatever he wishes to do. So, and you'll also look on these forms for questions, and because if you answer a certain way, it might require another form. So for example, as we move further down, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? So if you bought or sold crypto, if you anything along those lines that are, or I guess even NFTs, then you would put yes. They're primarily interested in the sale of those assets, not as much of inquiring. And when I say sale, I'm also referring to exchange. So if you buy one, let's say you buy Bitcoin and then sell it and buy, one of the other coins, that may trigger what they call a taxable event. It may be something that you have to pay tax on if you made a profit. So if you sold Bitcoin and bought Ethereum or one of the other ones, that might be a taxable event for you. But in this case, we answered no. So that doesn't trigger any other kind of a form that we're going to need to complete. So moving right along then. So they ask questions now regarding the standard deduction. So in this case, Joel is by himself. The question here is, someone can claim either you as a dependent or your spouse as a dependent, or your spouse itemizes on a separate return. Basically, you answer, just check off the box if any of these apply. If they don't apply, then you don't check them off. Also, there's a question regarding blindness. So when you were born, if you were blind, that may give you an additional tax break that you would then get, and it will help you to pay a lower tax. So now we then go to the next line down. So here you are required to put down anyone who is a dependent of yours. So if you have children or if you have an elderly parent who is officially a dependent for you, you will put their name here, first name, last name, social security number, their relationship to you. And if they qualify for a child tax credit, you check that off if it applies. If there is any other kind of a credit for dependents, then you would check the other boxes that are here. If they don't qualify, then you just do not check off those boxes. So moving right down then to really line 1. So here you would put down your wages, your salaries, tips, things of that nature. And your employer, when they give you the final number at the end of the year, they should give you what is called a W-2 form. This has all of the information about your income earned during the year, any taxes withheld, any money withheld for employee benefits, taxes withheld from state and local along with federal. That's all on here. So on your W-2 form, it's going to say, that this is the amount that you have to report for your federal taxes. So in this case, Joel Embiid is reporting $40,000 of his wages. That's what he said he earned for the year 2021. So moving now down to line 2, 2A and 2B, it looks like under 2A, he earned $100 of tax-exempt income. So the interest that he earns, the tax-exempt interest, may have been from a municipal bond, bonds that are basically free of federal tax. You still put it on the tax form, even though you don't actually pay tax on it, but they still want you to report it. On the other hand, let's say he had bank accounts, he had bonds, he had certificates of deposit that paid interest. In this case, he had $500. Those items that are taxable, he will then put on that line 2B. He also had qualified dividends. So dividends that for the whatever he held on to for a year, those dividends were qualified. So he puts the $100 into that section 3A, and he's going to pay a lower tax when on this qualified dividends. Finally, if he has ordinary dividends, this is something that's taxed as a regular ordinary income. In this case, he also has $100 here, so he'll pay tax on that $100 that is put in there. So there are other items here, other line items, IRA distributions, pensions, Social Security benefits, things of that nature, but he doesn't have anything here in those categories. So basically what you do under line 9 is you add up all of the items that were on the lines previous, and that gives Joel Embiid $40,600 as his total income so far. Now, are there any adjustments? So, whoops, sorry about that. Are there any adjustments? So if you file what's called a Schedule 1, anything from line 26, you would make those adjustments. He doesn't have that, so you just leave it blank. So now you take away, you deduct any adjustments. You have your total income on line 9. So line 11 now is Joel Embiid's adjusted gross income. So here's that important number that we talked about previously. So he has $40,600 as his adjusted gross income. So what I did for you here is gave you 2 examples. One example where the standard deduction was used, and another example where itemized deductions were used. So here's the one for standard deduction. So it just so happens that for 2021, for a single person, so Joel Embiid is reporting that he is a single person, his standard deduction is $12,550. That's what he is allowed to deduct as a single person. If he had itemized deductions that were higher than $12,550, he would put that number here. And I'm going to give you an example of that in a few minutes. So, but right now he only qualifies for the standard deduction. So that's $12,550. As it turns out, he also made a charitable contribution of $300. And even though charitable deductions are an itemized deduction that you're permitted, if you don't itemize your deduction, you may still be able to deduct part of your charitable contributions. So in this case, the $300 is within the allowable limit, and that's what he did. So on line 12C, you're now going to add together the standard deduction and the charitable contribution. So that gives line 12C of $12,850. Line 13, qualified business income deduction, doesn't apply here, doesn't have a business. So then you add together lines 12C and 13, which is 0. So now line 14 is $12,850. So you now then, you're going to, for line 15, you're going to subtract line 11, which is your adjusted gross income. You're now going to subtract from that line 14, which is $12,850, and that will give you your total taxable income. Remember, the adjusted gross income, the AGI, is before certain items have been deducted. But now these items have been deducted, and this is now your taxable income. So you're going to pay tax on $27,750. So now we're at the bottom of the page. We're going to move to the next page. Okay, so at the back of the booklet that you get from the IRS, there are tax charts, which I'm going to show you in a moment, as to how he calculated his taxes. So the tax that Joel Embiid owed was $3,134. All right, so where did he get that? So let me go to, I'm going to skip this page for now, go to the next one, which is the tax table for 2021. And these tax tables, they start basically from 0 to $1,000. So in this case, his taxable income, you'll recall, is, I'm sorry, whoops, page before, $27,750. So we're going to now look on the form, and we're going to determine how much tax he actually has to pay. So what you do is you go through the page and get to the point where your income of $27,007, I forgot the number. I'm sorry, $27,750. You go to where that is. So here's the page for 27,000. You go down the column, and he is at 27,750. He's between 27,750 and 27,800. So that's what he's going to pay, whatever the tax is that comes out. Remember, he filed as a single taxpayer. So his tax that he owes as a single taxpayer on the income that's between 27,750 and 27,800 is $3,134. So that's how much tax he is going to owe based on his income, on his taxable income. So remember that number, $3,134. So let's go back to the second page. And this is where you put the $3,134, where it says tax. Okay. Now, if you have any of these other schedules, then you put them in here, but he doesn't have that. So there's no other schedule that he's got to make an adjustment for. So he's just going to then take line 16, and then it's the same 16 as it is on 18. So he moves that down to line 18. He doesn't have anything that appears on line 19, 20, or 21. So there's nothing to subtract. So then he just subtract 0 from 3,134. So now he's down to line 22 with, again, the 3,134. He doesn't have any other type of taxes like self-employment tax, so he doesn't have to fill in anything on line 23. So now he's at line 24, $3,134. That's his total tax. Okay, that's what he owes. That's his total tax. Now, his W-2 form that he got from his employer showed that he withheld $3,300. All right, so he owes $3,134, but he actually had withheld from his pay $3,300. So he will then get a refund. All right. So moving along here, the W-2 form, which is where the 3,300 was showing, you now move that from line 25A to 25D. And since he doesn't have any other type of adjustments that are made, he's making adjustments for the credits, doesn't have anything to adjust. So now his total payments that he made were $3,300. So he owes $3,134. He has had withheld from his pay $3,300. So he's going to get now a refund from the IRS of $166. Now, if he just files a paper form and mails it in, it may take 6 to 8 weeks to get his money back, and it would come in the form of a check. On the other hand, if he fills out this information that you have here, the routing number and the account number, this is information that if he has a checking account, he can have the IRS send the money directly to his checking account. And this way he doesn't have to worry about waiting for a check in the mail. And he'll actually get his check, his credit of $166. He'll get that faster than he would if he was waiting for a check. There's a lot more processing that goes on when you have a physical check compared to sending something electronically. Okay, so finally now, he's finished his return. He's going to have to sign here and then date the form, put down his occupation, whatever job he had, or if he's self-employed, he'll mention what that is. And then there's also, if the IRS sends you a PIN number, this has to do with special identity protection, you would put that PIN number in here. If you don't have it, then don't worry about it. If someone prepared your taxes, they're going to sign right below here. So you would have the preparer sign your form after you have already signed it as well. Okay, so that's what happens if you file with a standard deduction. But let's say that you filed for itemized deductions. So I'm going to give you an example of that. So if you're filing your return using itemized deductions, you're going to use something that's called a Schedule A. Now, if you have tax software, they're going to automatically do this for you. But on the other hand, if you are doing a paper form like this, then you're going to be required then to get this other form, this Schedule A. So the Schedule A basically walks you through what itemized deductions are. And remember, if your itemized deductions are larger than your standard deduction, then you can deduct the itemized deduction and save some taxes. So let's walk through this and I'll show you how that works. So first of all, just like any form, as I mentioned, you got to put your name and your social security number in case your paperwork gets separated. If you're filing on a electronic platform, if you're filing your taxes by way of a TurboTax or any kind of software like that, they'll take care of that for you. You don't have to worry about it. All right, so in this case, let's look at what his deductions were. So it turns out that Joel Embiid had $5,000 of medical or dental expenses, medical and dental expenses, I should say. Now, he's only allowed to deduct up to a certain amount. So it's anything over the certain amount. So in 2021, it was anything over 7.5% of his adjusted gross income. So his adjusted gross income was $40,600. 7.5% of that is $3,045. So he can't deduct the first 7.5%, but anything over that, he is allowed to put it under itemized deductions. So he had $5,000 of medical and dental expenses. He cannot deduct 7.5%, the first 7.5%, which is $3,045. But he's allowed then to itemize the difference between those two. So he can put down under medical and dental expenses $1,955. So that's the first item that he has on there. So next he's going to look at his state and local taxes. So you look at if it could be on your W-2 form, the amount of state and local taxes that you paid to those local governments. If you paid real estate taxes, property taxes, things of that nature, all of these taxes, they then get put onto here. You can't put on there, though, your federal tax because you're doing a federal tax form. You only put the other taxes that are that have been paid out of your pocket, but not federal taxes. So you total them up. In this example, he's allowed to deduct $4,900 worth of his taxes. There may be some restrictions, but in this case, they don't apply to Joel Embiid. So the $4,900, I think I said $4,500, the $4,900 is then placed right here. So far he's got $1,955 of medical and dental and taxes paid of $4,900. Now, he has a mortgage and he has paid $6,000 of interest on that mortgage. So he puts the mortgage interest then right here on the amount there on line 8A. So he doesn't have any other types of mortgage deductions that he gets. So he'll put the $6,000 of mortgage interest right here. And now he's got three items. So the amount that he's got is getting higher and higher and higher. Maybe he's going to be able to itemize his deductions. Well, as it turns out, he gave $1,000 to a charity or to charities. So he puts those items that are in the form of cash or a check. He will then put that amount here. So he gave $1,000. That's all he gave. So that $1,000 carries from line 11 to now line 14. So he has $1,955, $4,900, $6,000, and $1,000. You add them all up together, and that gives him itemized deductions of $13,855. So in this example, his itemized deductions of $13,855 are larger than what his standard deduction was. And you'll recall that his standard deduction, this is going back to the first example, the standard deduction was $12,550, but his itemized deduction is $13,855. So you deduct the higher of the two numbers. All right, now, does that make a difference? It sure does. So this is now the tax return using the itemized deductions. So let's see what it does to his final taxes that he's owed. So he had the adjusted gross income of $40,600. He then deducts the itemized deductions of $13,855. So that now gives him taxable income of $26,745. Okay, so under the old way, under the standard deduction, he had taxable income of $27,750. But now his taxable income is $26,745. So if we move along here, we will see, using the same chart that I told you about, and the same way that you look it up, he will owe $3,008. Okay, so again, you follow down all the same numbers the way that we did. He owes $3,008. You'll remember he still had $3,300 withheld from his pay. So the difference then between what was withheld from his pay, $3,300, versus his tax owed, which is $3,008, is $292. So he's going to get back $292. Under the standard deduction, he was only going to get back $166. So he's going to get back an additional $133. Not bad. So again, it all depends on what your itemized deductions are and if you qualify for them. If not, then you just have to take the standard deduction. All right, just a few more items here and then we'll be finished on taxes. And of course, continue to read the information that I have in the module for you. So let's say you don't want to do your taxes. It's too confusing for you, or maybe it's complicated. So you can go to a commercial tax preparer like H&R Block. They can do your taxes for you. You can go to a certified public accountant. These people have they have a special designation. They studied very hard to get that designation, and they have to stay on top of what the tax laws are. So you can go to these people. Now, of course, the fancier the person that you're going to go to, it's going to be more expensive. So you're only going to want to go to the really high-powered people if you have a complicated tax return. So if you have real estate, if you have lots of itemized deductions, if you have lots of investments, then it may pay you to go to a professional who is even a step above a commercial tax preparer like H&R Block. So you could go to a CPA, you could go to a lawyer who specializes in tax, and they might do your taxes. There is also something called an enrolled agent. Now, an enrolled agent is somebody who has completed a special test with the IRS, and you may see the letters EA after their name. These are people who are allowed to represent you if they do your taxes and you are audited by the IRS. These are people who are allowed to speak on your behalf. These are called enrolled agents, the EA. So you've got H&R Block, you've got CPAs, you've got lawyers, you've got EAs, enrolled agents. Anybody who is a tax preparer must register with the Internal Revenue Service. They want to make sure that they've got control over who it is that's providing you advice and whether or not they are legitimate. Now, all taxpayers can do their own tax returns as well as change the oil in their cars, but many prefer to pay someone to do both. Years ago, I used to change the oil in my car. I don't do that anymore. I use TurboTax for my taxes. I don't do a paper form anymore. Okay, so it all comes down to how complicated your tax return is. A tax preparer is going to provide you with experience and knowledge. So sometimes it is worth it to have them do all that for you. They're also saving time for you, and the idea is to also save you money. So when you are doing financial planning, and this is, as we'll talk more about this as we get into investments and things like that, you're sometimes allowed to adjust things. Again, if you're doing it legally, and then sometimes you can do it, sometimes you can't. But let's say, for example, your employer wants to give you a bonus. And if they give you the bonus now, that's going to put you into a higher tax bracket, which is going to mean you're going to pay a higher amount of taxes. But let's say next year you're going to retire and maybe you're not going to have as much income. So if your employer is willing to give you the bonus next year, it's possible that by shifting that income from this year to next year, you may wind up with paying lower tax. So uh, again, you have to crunch the numbers to see whether this makes sense. But again, that might be a possibility. Also, if you have some deductions, if it's an expense that you know you're going to have to pay next year, but you've got a lot of income this year, if there's a way of paying for those things now instead of next year, you can get the deduction this year when your income is higher, and therefore you're winding up saving more uh, of your, reducing your income and lowering your tax. You can also convert income. So if you have an investment and you want to sell it before 12 months are up, well, that's going to be considered as ordinary income, the gain that you're going to make. But if you can wait a little bit longer, then it becomes a capital gain if you hold it for at least a year. Now, that's not always the smart thing to do. The investment, and we'll talk about this when we get to it, the investment is really what has to determine when to sell, not necessarily the tax implications, but the tax implications are certainly a consideration in what you're going to do. Okay, so understand that preferred stock is stock and the dividends can be qualified, which means that then you would pay a lower tax rate. On the other hand, bonds don't have that qualification. You're not an owner when you own a bond. You are a lender. And so therefore, any income you get from government bonds, except if they're municipal bonds, those are tax-free. But corporate bonds, CD, interest, things of that nature, those are non-qualified. You're going to pay ordinary income tax rates. Okay. Dividends are subject to possibly being qualified, and you pay a lower tax on that tax rate. Interest, on the other hand, is not qualified. So you're going to pay at ordinary income rates if you can. In other words, if you're the investment you have is, if you're going from a dividend to interest, remember that it's possible you could wind up paying more tax when you do that. State and local bonds, their interest is exempt from tax. And also, if you are living in the same state where those bonds are issued, you can be free of federal, state, and local taxes. So for example, if I live in Montgomery County, Pennsylvania, and let's say I live in Norristown, and I own a Pennsylvania bond, I not only not have to pay state and local tax on that bond, but I also don't have to pay federal tax because I live in the same municipality that issued that particular bond. And that's the ruling. That's the way that the rules are for municipal bonds. Two more items. You may hear the term tax shelter. A tax shelter is an investment where part of the return is from tax savings, that a taxpayer then pays less taxes because of the investment. An example is ownership of real estate investments. Frequently, real estate investments have a loss that can reduce tax on other income. Thus, part of your return is the tax savings that you get from the loss. Note that real estate losses are generally passive losses, which can only reduce passive income. So, for example, you have a property, an investment property, and you charge rent. But let's say that your expenses for that property are greater than the amount of rent that you took in. So you now have a passive loss. You may be able to deduct that passive loss from any other passive income that you have. Let's say you own other properties. Okay, and maybe there you have a positive income. As long as it's passive income and you have passive losses elsewhere, you can offset the losses with the gains. That's a way of using a tax shelter to save taxes. And that essentially has saved you money, even though you lost money on one of those investments. That's passive investing. Okay, finally, tax audit. So if something is wrong with your tax form, and usually what will happen is you'll get a notice from the IRS in the mail. Okay, nobody's going to call you first. Okay, this is how people get ripped off. Now, remember, the IRS is the one that enforces the tax laws. The IRS doesn't make the laws. Congress makes the tax laws. The IRS enforces the tax laws. Remember that. And that may be even a question you have to remember. So it's the IRS's duty to make sure that everybody's paying their fair share of taxes and they're doing it legally. So if they see something on your tax return that doesn't quite look right, they're going to reach out to you. Now, they don't check every single tax return. Electronically, what they do is the information goes in there, and if your numbers are within a reasonable amount, then they're not going to question your numbers. Okay. On the other hand, if you have an extremely high deduction for something that's really, really out of the ordinary, then they're going to bounce that out as far as taking a look at it. They're going to say, wait a minute, what's this all about? So they will, they'll do a sample of these kind of return reviews. But if something is really out of whack, they're going to take a look. They may also just out of a random sampling, they may also choose to audit your taxes. Now, nowadays, it's a very small percentage who get audited. I think it's less than 5%. So if this happens, keep calm, gather your records. If you made an error, then you learn from it. But here's a couple of things you have to remember. First of all, the IRS, if you come in and you look very much disorganized, that's going to go very much against you, because what you're trying to do is to show them that you know what you're doing. And especially if you don't have an accounting preparer like a CPA or an enrolled agent, you're on your own. Okay. H&R Block, I think they will represent you as well. But if you're doing this on your own, you have to put on a really good show to the IRS and convince them that you know what you're doing. So if you come in and your records are all disheveled, that's going to count against you. They may not tell you that, but that is indeed the case. You're not helping them feel confident in your ability to do your own taxes. Okay, so you want to be organized, okay? And if there is something that you have an extraordinary expense item that has occurred, you want to make sure that you have all of your documentation right there when you get audited, because they're going to ask you for that. Okay. If you made a very large charitable contribution, show me the money, as they say. Show me the tax form that the charity provided to you, saying that you provided this amount of charitable deduction to that charity. If you don't have that, they're going to reject your tax return and they're going to make an adjustment. And if it's a big enough adjustment, you're going to wind up paying taxes instead of getting a refund. And you don't want that to happen. All right. So audits can happen. Just make sure that you're not getting too far out of the ordinary. If you do have a legitimate tax expense, make sure that you bring all of your records to the audit to show the IRS that this is a legitimate expense. Now, what they might do, instead of bringing you in, is they'll say, okay, can you explain to us what this is that you're deducting? And if you have any receipts, send a copy of those receipts in with your letter explaining what it is that you have here. And if you send the information in and it makes sense to them, then you're not going to have to go in physically. Then they will, say, okay, your audit is fine. Thank you very much. Move on from there. Okay. If on the other hand, if they don't like what they see, then they may bring you in for a personal audit. And then at that point, you better make sure that you have all of your tax items with you, because again, you don't want them to reverse what you reported for your tax return. It could get to be a very expensive thing for you. Okay, I hope that I haven't thoroughly confused you. The more taxes that you prepare, the better you become at these things. So, and like I said, some people have a professional do them. If that's the case, that's fine. I would suggest, especially if you're new at this kind of thing, do a little bit of study on your own. It would help you to understand the tax laws, especially if you're a business major, and very much especially if you're a finance or accounting major, because those people, very often the decisions that they make will be affected by taxes. Okay, any questions along the way, by the way, shoot me an email or, whatever works best for you. Preferably use it within the Canvas system if you can do that. If not, then send me an email. All right, we'll move on then to the next section. Thank you.